The following is for information purposes only and should not be considered investment advice. All opinions and views expressed by the contributors to this podcast are in a personal capacity only. They do not represent the views of Progressive Equity Research or any other organisation mentioned in this podcast.
Money never sleeps, pal.
Okay, so it is Thursday, 2nd of May. I've got Jeremy McEwen with me as usual. And this week we're joined by Alastair Stewart for the second time to give us a bit of an update on some goings on within the building construction sector. So welcome, guys. Good to have you here this afternoon.
Hi.
Hi.
Jeremy, do you want to kick off by giving us a quick update on what's been going on in the macro space over the last 7 days?
Yeah, so it's been, I think compared with last week, quite quiet, really. We started off with lots of concerns around what was going on in Asian currency markets, particularly the dollar-yen rate, which was causing much concern. I think at some expense to the Bank of Japan in supporting their market, their currency on their bank holiday Monday this week. They've managed to stabilize things, but I don't think we're necessarily out of the woods yet. The big news this week was the Fed policy rate decision.
Mm-hmm.
No surprise that rates were unchanged, but that level of interest rate, along with a 10-year rate that's heading towards 5% in US Treasuries, is putting all kinds of pressure on the yen due to the nature of the carry trade, with a bit of overspill as well. Pressure on the Chinese renminbi as well. So a lot of volatility in Asian currency markets that could remain consequential.
No, that's right. Well, you've been talking about Japan for some time, and I've become quite used to you being proved right on these things, but I'm not used to those correct predictions turning up on the BBC News. And when it hits the BBC News, as it did over the weekend or Monday, clearly people are worried and it's starting to rattle global markets. So I think you've been spot on.
But I think the big news this week was not really the rate decision from the Fed. I mean, there's lots of column inches written about nothing new happening, but it's worth reminding yourself that during the press conference, he thought it was necessary to take the idea of a rate rise off the table. And I don't think he did that particularly convincingly, to be honest. So the US economy is running hot and inflation is sticky. And if you just think back 6-9 months, we were expecting rate cuts to have already begun by now. And probably the consensus view is that we won't be getting rate cuts from the US possibly until the fourth quarter. So that's a big change. And that's reflected in other financial markets, certainly currency and bond markets. But the equity market globally, I would say equity markets have been relatively immune to this change, and that can't go on forever. The big one next week is the Bank of England rate decision, and whether the Bank of England or any other Western central bank will be prepared to take a decision to lower rates without taking the lead from the Fed. And that remains to be seen.
And your view previously had been that that was unlikely, but I suppose the longer the US stays higher for longer. It's funny because higher for longer has almost become the risk of could actually be higher.
Even higher for even longer. Yeah,
exactly. So in that world, maybe Europe or the UK is prepared to cut before the Fed does.
We'll find out. There were suggestions that Canada's prepared to go early, but in a world of dollar dominance and currency volatility, I think policymakers will be nervous. But as I've said before, I don't think there's any other economy in the world, particularly none in Europe, that can live with this rate of interest rates. And we are, in that sense, really crying out for lower rates sooner than it suits the US.
Absolutely right. And one area that will be definitely impacted by rates or those rate decisions is the building construction space. And
Absolutely,
It's great to have Alastair back with us again today to give us a bit of an update. I think it was Bob Dylan said you don't need a weatherman to know which way the wind blows. But in this sector, we've got a pretty good weatherman, and it's you. So it'd be great to hear what you've spotted. And I know you published a column in Property Week this morning, so it'd be good to understand what you've put in that and what you're seeing in the sector.
To maintain the meteorological analogy, land buying in the house building industry is very much the barometer of which way the housing market's going. And in recent weeks, really, there appears to have been a very rapid change in the number of house builders prepared to buy land. Last year, following the rate rises, virtually every house builder said they were almost totally cancelling all their land buying because of fears of interest rates. And they all started using terms about being, quote unquote, very selective in the land market.
Mm-hmm.
I'd seen the wider housing market, the second-hand market, improving really since October, and most data incrementally has got better since then, both in terms of pricing and then in terms of buying volumes.
Yeah.
But house builders had still not really changed their volume guidance, even in the latest set of results and trading statements. But I noticed something in Taylor Wimpey's trading statement. They had previously been the first to say they were very selective. And then this time it was merely selective.
Small change of wording, but significant change in view.
Very significant. Now, the reason being is the house builders have seen a much quicker uptick in visitor numbers, in reservations and actual sales than they expected. And the long and the short of it is some of them are running out of land. And they're also concerned that if they don't buy the land, one of their competitors is. And I've been speaking as part of this property week. I was talking to land promoters, land agents, and some of the industry data gatherers. And there had been a small uptick in their land buying just before Christmas, but it's really gathered pace. And the thing is, once house builders stop buying land, the cash starts piling in when they're selling houses but not buying land. And now they're back in cash rich, piling into still quite a restricted supply of new land. And the big house builders are buying land aggressively. But at the same time as they were saying that they were becoming more selective in buying, they'd also started making bulk sales to private rental funds, to housing associations and so on. Bulk sales of land that was discounted just to get their cash flow up and prevent some risk. I spoke to the chief executive of one of these funds, and he said he'd been in advanced negotiations with two big house builders over 10 pieces of land. And in recent weeks, those two house builders had pulled 8 of the 10 sites in question and decided they needed the land more themselves. So it's a big sign, not only that they're feeling more confident, but also that they're going to start building on site. And so although the house builders have been not changing their guidance on volumes for the full year, even then they were saying it's more second half weighted. I think by the half year stage, when they start giving guidance, the first half could have been better, and they're going to have to raise guidance for the full year.
That's really interesting and obviously very positive for the house builders themselves, but it has knock-on implications for the people who supply the house builders. So I'm thinking the brick manufacturers, but probably others who are going to be in a better state as we go through the year.
Well, it can certainly help the early stage suppliers of building materials.
Yeah.
But remember, the brick manufacturers, and one of them is our client, Forterra, they have cut back their capacity in the face of a smaller market.
Yeah.
They can quickly come back on stream again, but they've got very efficient capacity. And when they've got not huge inventories, that means there'll not only be a big pickup in volumes, but also positive pricing power for them. Other people could be the civil engineering contractors, and there are some specialist contractors like Van El who put in bespoke foundations for house builders. So that could be a benefit to them. But another group is the land promoters themselves. MJ Gleeson and Henry Boot are two companies that do a variety of work. Gleeson do land promotion and house building, and Henry Boot also do house building and a range of other property type activities. But that would help them because the high margin part of their business quite often is this land promotion side.
But it might be problematic for the buy to rent social housing players who are not going to get first dibs at the access to this land.
Indeed. And I think even the house builders have been surprised by the speed at which things have turned up. And it really, nobody's been talking about it until today.
Yeah.
Sounds very encouraging. What else have you been looking at this week, Gareth, in the UK?
There's been a bit going on. There's been a steady flow of updates and results coming through. A couple of ones to mention. Concurrent Technologies had another strong set of results with revenue strongly up, cash doing well, and clearly delivering on the transformation which the relatively new CEO, Miles Adcock's been putting in place there. So great to see Concurrent still moving strongly in the right direction. We've also had IG Design, a progressive client who gave us a very positive update. The shares were sharply stronger as they're performing well. Still difficult market for them, but they certainly seem to be doing some very company-specific good things and delivering well there. More broadly, we had some news from Revolution Bars, which I think is quite a well-followed stock. They're considering doing a deal with Nightcap, so a bit more M&A coming through. And then finally, Smith's News, I noticed. Relatively small announcement. It was a refinancing they announced. I think it was this morning. But that really caps off a multi-year turnaround, which has been very, very professionally delivered. They've done a very, very good job of transforming the business, reforming the way that it's managed and where it focuses, and the share price has been exceptionally strong over a multi-year period. So I think they've done a fantastic job there, and good to see it refinance well this morning.
As a highly cash generative business that has struggled to reposition itself, but they said they'd done the refinancing today and could now focus on their capital allocation policy. And I'd noticed a number of smaller companies reporting their results returning to the dividend list, which individually might not amount to a lot of return to shareholders, but collectively is starting to.
Yeah.
The other thing we've seen this week has been a new £3.5 billion, I think it is, share buyback from Shell on the back of some strong results, and an offer for Alpha Financial Markets, which, albeit an early stage, is a sort of £500 million plus business that could get taken out by private equity, which obviously a shame to see a company like that leave the market. But in terms of capital flows into small cap, these things add up. Just anecdotally, watching the way share prices behave on the back of inline results or slightly better than expected news, it's really apparent that there's just a better feel and a better flow of capital into the lower reaches of the UK stock market right now.
Yeah.
And I've noticed a few comments in the press about it that, things do seem to be looking up. It's happening at a time when the US stock market is struggling a bit, particularly the very large tech stocks over there.
No, absolutely right. And I think you're right to highlight the Shell share buyback. But I think every morning now you're seeing reminders in terms of the share buyback activity from a large number of stocks. It certainly feels like share buybacks are becoming more and more popular with the number of companies. And so, there is a steady return of capital. And so hopefully people will be redeploying that, and it gives prices a chance to move upwards. So lots going on. What about next week, Jeremy? What have we got in store for us then?
It's sort of all about the UK next week. On Thursday, we've got the rate decision from the Bank of England. And Friday, we've got Q1 preliminary GDP data for the UK, which is sort of quarter on quarter. The expectation is for 0.2% improvement, 0.5% improvement year on year. This evening, we're going to have Q1 earnings from Apple, which could be consequential. And tomorrow, Friday, this week, we're going to get non-farm payrolls, employment data from the US, which also could be consequential in terms of the direction of travel of interest rates in the US. But overall, it's unlikely that the Bank of England, I think, are going to cut this time round. But there does seem to be growing dispersion of opinion on the MPC about when rates should be cut. And of course, there's this dilemma about whether they would be prepared to cut ahead of the Fed. And obviously important for the house builders as well. But in the meantime, it's good to hear Alastair's cheery news from the UK house building sector. Yeah. That's great.
No, that's right. Well, we look forward to seeing that play out over the coming weeks and months. But no, Alastair, thank you very much for coming back on the show. And Jeremy, as always, thank you for your comments. And we'll catch up this time next week.
Okay.
Thank you.
Thanks very much.
Brought to you by Progressive Equity.
This is your wake-up call, pal. Go to work.